Trump's tariff announcement, a reminder to investors on the market volatility that can come with the second Trump presidency as a balance fades, at least for now. We want to bring in Brian Nick. He's a NewEdge Wealth head of portfolio strategy. Brian, I'm curious what you're making of the headlines that we've gotten out over the last 24 hours.
Yeah, it was sort of a flashback to the the late 2010s when you could be on social media and you get these flash announcements and pronouncements from Trump that he's going to put these tariffs on. And
it would wake me up in a cold sweat, Brian.
Got to dust off my graphs of trade policy uncertainty and volatility correlations. But I think you guys put it really well. There's two questions here. One is, what would be the impact of these tariffs if they were implemented? And then second, what's the probability that these tariffs are going to go forward as announced? And there's going to take some time. It's not a day one thing, right? There's a review period. There's a commentary period. I think the markets are able to look through this, expecting that maybe, in a kind of a broad-based sense, there's not going to be, quite as severe tariff put on, especially Canada and Mexico, as the announcement. But I think if you're a company, an individual firm that relies on imports from these countries, these very, very large trading partners that we have, you probably have to start reacting now. You can't afford to wait and assume this isn't actually going to happen. So it makes sense that you see the price reaction in the car manufacturers. There's so much back and forth. A lot of times these cars are imported and exported multiple times as they're being built between Canada and Mexico, so it's insanely disruptive to have this uncertainty hanging over. And you may see stockpiling of parts, component parts, big businesses, but also small businesses that have to pull forward some of their purchases into Q4 because they don't want to wait to see how expensive it might be in Q1.
What do you think the effect of that stockpiling is, especially if you were to pull forward the purchases? You're pulling forward an expense or a cost of goods and services as well. So how does that factor into outlooks that we still have yet to hear from some companies, but for some that have already reported this earnings season, they might already have to start factoring that in, and we may even see some revisions come out too.
Yeah, I mean, there's two things here. One, just mechanically in GDP, Q4 might be a little bit higher if you have a lot of inventory stocking pulled forward, and that might mean Q1, Q2 are a little bit weaker. So you might just get a little bit more volatility in GDP. But I think the other thing that might happen is if you get a lot of demand suddenly for a limited number of goods that maybe Canada is producing, it's harder to stockpile things. A lot of things we import from Mexico are perishable, so you can't stockpile tomatoes and fruits and vegetables and things like that. But the things that come from Canada, if there's a big rush of demand, that could push prices up too. And what you saw in 2018 is a lot of times the price reaction in the individual goods that were being subjected to the tariff would happen before the tariff went into place because the anticipatory demand would cause a spike in those purchases.
Brian, when it comes to the strategy, I guess how investors should be thinking about this, what should they keep in mind, just given the fact that there is so much uncertainty and so many unknown variables in terms of how this is actually going to play out?
The two things that trade policy uncertainty specifically do is they create volatility in equity markets. They create dispersion in individual sectors, winners and losers, because there's very concentrated losers in a lot of these scenarios. But what we tend to see is that the volatility associated with trade policy uncertainty is not a zero-sum game, that you end up with less investment, lower GDP growth than you would get otherwise. And that means that we want to be positioned somewhat more defensively. We were already anticipating slower GDP growth, slower earnings growth in the S&P 500 and Russell 2000 next year. I think that what we are likely to get as a result of these tariffs and the uncertainty they create is more of that. So we're positioned defensively. We have in fixed income, we are overweight the longer duration parts of the curve. You actually haven't seen bonds rally, which is interesting. I think there's still some ambiguity about how people feel like these tariffs are going to affect interest rates and what the Fed needs to do. But on the equity side, we're also positioned more defensively, emphasizing profitability, quality, and not chasing a lot of the kind of the junkier names that have been leading the rally the last couple of weeks.
On the other side of this, if it's not as bad as it could be, does that just initiate some massive relief rally?
Potentially, but it doesn't look like the markets are going to open down that much. Overnight, there was a dip. But I think in terms of the individual sectors being affected, yeah, you could get, it's almost like, bending a hose and then letting the hose go.
Right.
You don't end up with more water, you just end up with different velocities at different times. So I think it just adds to the choppiness, the churn that we already thought was going to be sort of characteristic of the equity market next year. But this just adds to it. And I think by no means should we expect this is going to be the last one of these kinds of announcements.
Brian, when it comes to, I guess, the odds that we're going to have a Santa Claus rally, what exactly that looks like going forward? There certainly was optimism. Does this at all change that calculus or no?
I don't know if consumers are going to be that focused on this particular issue yet. I mean, anticipating that in February or March you might have to pay more for fruits or vegetables. We already know that people are very skittish when it comes to grocery price inflation, this would make things worse. But I think unless and until they actually go into effect, I don't think you'll see a consumer response. You are already seeing a little bit of a mixed bag, and a lot of these companies reporting, like one day you get Walmart with very good reports, one day you get Target with not great reports. We think that the jury is still out on the consumer for 2025. It looks like we're going to have a pretty good end-of-year shopping season, but with the labor market softening, with wage growth declining, I think the thing that's really keeping the consumer alive right now is there's definitely animal spirits associated with higher equity market valuations. People feel wealthier as the value of their nest egg, their 401k has gone up, and that is one of the things that drives people to decide to save less and spend more. And until we see an equity market shake or decline or some kind of correction, I think consumers are going to still feel pretty confident about their ability to spend.
You know, it's so interesting, and I don't want to jump the gun here, but I'm going to jump the gun because I was speaking with the Smucker CEO, and we're going to break down earnings a little bit more. But one of the things that was interesting that he told me was the discretionary spend that consumers are really being more diligent about and asking themselves, even in the grocery aisles, hey, do we need that extra discretionary snack? Do we need that thing that is not just the absolute nutritious thing that is necessary for us to have in the pantry or in the refrigerator? How do you think that mindset really permeates through into some of the names in the market as well, and those that are set to best positioned to outperform versus others that are a little bit more vulnerable to discretionary spends?
I think this is particularly true when you're looking at sort of we call the kind of the K-shaped consumer right now, where you have some consumers who are at the lower end who are doing more of what you're talking about, or spending less, are having to maybe decide between making a large goods purchase and maybe taking a trip or something else. And then there's people at the higher end who are more reliant on their wealth and their feeling of security that they can continue to spend at the rate they've been spending. And to the extent that becomes more of an issue, you could actually see some of the lower end consumer names continue to struggle. Some of them have, like Dollar Tree, because those consumers are making the cutbacks and the higher end consumers aren't necessarily at this point. I do think, though, when you look at things like the savings rate being as low as it is, that reflects decisions on the parts of consumers. When the savings rate starts to go up, that's when we start to worry. It's a little bit counterintuitive. You think as people save more, that tends to mean the economy is slowing down and consumers are becoming a little bit more cautious about what they're doing. So if we see that in the numbers we're going to get tomorrow on PCE and we continue to see it, that's going to be a sign that you should expect slower consumer spending next year.